before the idea of a trillion-dollar company was, an extreme thing. And now, companies have been over 4 trillion. A lot of these companies over the course of 5, 10, 15 years reached heights that most people did not expect them to. And they just kind of kept every time they would say, okay, this price to earnings multiple is a little bit high, or this is kind of concentrated. For a period of time, it might cool off for 6 months or 12 months, and then it just has another rip higher because it's fundamentally being adopted, whatever kind of product or service they had. And I think Bitcoin's kind of in that phase now, where there are some bears that are saying 2 trillion market cap. That's kind of enough. How could it possibly go higher than that? It's magic internet money.
When people talk about market cycles, they often picture neat, predictable waves. Every 4 years, the Bitcoin halving comes and prices explode. But what if this time, the real driver isn't the halving, but liquidity itself? Over the last few years, we've seen the same story unfold across assets, from Nvidia's meteoric rise to Apple's dominance. Companies once thought overvalued just kept breaking ceilings. And now, Lyn Alden believes Bitcoin may be entering a very similar phase. Like those mega-cap stocks that defied gravity, Bitcoin's next chapter could be one where adoption, not hype, pushes valuations higher than most skeptics can even imagine. In a recent interview, macro strategist and investor Lyn Alden broke down why this cycle has confounded both bulls and bears, and why the market's sluggishness might actually be setting the stage for something far bigger. She argues that Bitcoin is evolving beyond the simple 4-year boom and bust model. It's no longer just about halvings or new supply. It's about who owns it, how it's traded, and what kind of liquidity backdrop it's sitting in. Think about it. Alden points out that today's Bitcoin is held by institutions, funds, and sophisticated investors who rebalance their portfolios like they would any other major asset. That changes the rhythm. It makes each correction longer, but also more structurally sound. And while prices have lagged in 2025 compared to sky-high predictions, Alden sees that as consolidation before the next expansion, driven not by halving cycles, but by macro liquidity, fiscal spending, and the same forces that have lifted traditional markets to multi-trillion-dollar heights. So in this video, we're breaking down exactly why Lyn Alden believes this crypto bull market isn't over, just maturing. We'll look at what she sees happening with liquidity, how her Bitcoin forecast has evolved, and what the next 12 months could mean for investors like us. If you find value in deep data-backed market analysis like this, make sure to like this video, subscribe to the channel, and drop a comment with your thoughts. Do you agree with Alden's long-term bullish thesis, or do you think this cycle's already losing steam? Let's dive in.
So I don't think we're in a full-on bear market. I think we're obviously in a weak portion of the cycle, and Bitcoin has been roughly flat for 12 months now. It's kind of had a lack of catalyst. It's kind of one of those things where it gets ahead of itself for a period of time and then corrects. And some of those corrections go on for 6+ months. This one basically went on for 12 months, even though there were new highs along the way. I've kind of been in the camp of always kind of being a bearish bull, which is I try to avoid price targets, more focused on direction because you can't necessarily predict illiquid moves and kind of euphoric periods or kind of lack thereof. But when I do get kind of cornered into giving a price target, I think one of my main ones was 150K for this year. So it looks like we're probably not going to touch that. But like John said, we still have 2 months to go. So we'll see what happens. And so that's we hit 125 or change. I had a similar thing last cycle where at first my target was $1 trillion market cap, which was somewhere in the ballpark of 50K. We touched that. And then I gave a target of, I think we'll hit 100K. That was still lower at the time than many of the bulls. We ended up not reaching that. We ended up only getting to 69. So far we're kind of in a similar thing where we kind of hit initial bullish targets, new highs and all that, but then kind of stagnate a little bit. I generally wouldn't look too much into this whole kind of 4-year cycle aspect. As the halvings continue, the new supply is a much smaller component of the total supply and demand out there. It's more about what price will unlock coins from existing holders, either because they want to sell into bullishness or because they're selling into weakness. They're afraid of their position. Either one. That's the type of thing that can really kind of affect price more so than what is the kind of the rate of new coins hitting the market at this point. In addition, prior cycles, because it was a much smaller illiquid market, and with kind of in general on average less sophisticated kind of participants, not necessarily in terms of like intelligence or anything like that, but in terms of hedging, in terms of kind of how they tend to rebalance and stuff like that. We had kind of more non-financial people involved, basically people that are sophisticated in other areas, not in terms of like sort of portfolio management. It didn't really follow normal rules of assets. Whereas now that it's kind of held by those who tend to hold other assets, they tend to treat it like they do other assets, which often results in rebalancing and things like that.
Yeah.
And so in prior cycles, like the market cap would get way ahead of the on-chain cost basis. And so it kind of like some of that price spike would be ephemeral because it's like it didn't really reach that price on a sustained basis. It was just kind of like a small number of coins would then, when you extrapolate over the whole market cap, kind of say this is the current price, but it wasn't like a price that was kind of a very illiquid price. And so I think we're past those kind of periods of just massive disconnects. We still have the on-chain average cost basis inching up at this phase. So I generally think that while it's been weaker than expected, I generally view that the cycle is going to go on longer than expected because I think we're driven by other things ranging from regulatory actions, ranging from liquidity, ranging from all sorts of other things, fiscal, economic stuff, and very much less so to a nearly negligible degree, the supply halving cycle. Yeah, I think an example to be familiar with is the Mag 7 stocks, basically these really kind of mega cap US tech stocks over the past 15 years. For a lot of them, if you ask, what cycle were they on? I mean, not a particularly, specific cycle, and the booms and busts were muted, because they started from a larger base than Bitcoin was, 15 years ago. And they've gotten, some of them to a larger market cap than Bitcoin is now. And, they've traded in traditional markets. And if you ask people, before the idea of a $1 trillion company was, an extreme thing. And now, companies have been over 4 trillion. I think Nvidia might have touched 5. I'm not sure, but several have touched 4 at this point, and more have touched kind of 2 and 3. And so a lot of these companies over the course of 5, 10, 15 years reached heights that most people did not expect them to. And they just kind of kept every time they would say, okay, this price to earnings multiple is a little bit high, or this is kind of concentrated. For a period of time, it might cool off for 6 months or 12 months, and then it just has another rip higher because it's fundamentally being adopted, whatever kind of product or service they had. And I think Bitcoin's kind of in that phase now, where there are some bears that are saying 2 trillion market cap. That's kind of enough. How could it possibly go higher than that? It's magic internet money. How could it go higher? Kind of like how could a phone company, like Apple, how could that, get as high as it is, or how could an operating system company like Microsoft get as big as it does? Or, and I think basically over the next 5, 10 years, it's going to kind of behave like that, where it surprises bears to the upside, where it just gets bigger and goes on for longer than they think. But it doesn't mean that basically bulls are going to be entitled to 5x multiple gains in like a typical 12-month period. It's not on that kind of easy 4-year clock as it was for a period of time. And I think even the 4-year cycle, and I've done research on this, the last couple cycles, it was kind of a blend of the halving cycle and the liquidity cycle. And so just as basically we have the kind of the importance of one declining to the point where it's almost negligible now. And then those other factors kind of gradually increasing in prominence as they affect Bitcoin's price.
Alden's take on Bitcoin's price action this year is refreshingly realistic. While she acknowledges the market has underperformed relative to bullish expectations, she emphasizes that it's not a breakdown, it's a pause. The asset's flat performance over the past 12 months, she explains, reflects a period without major catalysts, not a collapse in fundamentals. Her view? Bitcoin's in a weak phase of the cycle, one that naturally follows overheated rallies. But this time, the length and shape of the correction reflect deeper changes in market composition. The investors driving this cycle aren't the euphoric retail crowd of 2017 or 2021. They're the institutions that treat Bitcoin like any other part of a diversified portfolio. That shift, she says, means less volatility, slower moves, but a longer, stronger bull market overall. And that sets the stage for the next part of her analysis, the real macro drivers. Because as Alden sees it, the key to Bitcoin's next move won't come from mining rewards or halving cycles. It will come from liquidity. How much capital is circulating globally, and what central banks and governments do next.
So I do think factors are the key drivers. Basically, the type of things that drive a lot of high quality assets up, or put kind of near term pressure on a lot of high quality assets. Various things related to the hardness of money, liquidity, that kind of thing. A lot of the factors you cited, and then as you point out, I mean, unlike 2022, we don't see a major contraction in a lot of these things. Instead, some of them take a pause for a period of time. Others are still accelerating. And so I expect the numbers to be pretty good in 2026 and 2027. I think we're ending the period of Fed balance sheet contraction. We're entering maybe a flat period for a period of time, and then most likely expansion for a while. I would say not at the rate that some people think. My general view is that we're not going to get some massive QE anytime soon, but that instead we're going to return to a period of kind of structural balance sheet increases at a moderate pace, and that over the kind of longer term is beneficial for a lot of assets, including Bitcoin. And it's more the persistence of it, kind of the length of it. And I think another factor that kind of weighs it is that because we have a two-speed economy or K-shaped economy, depending on how you want to refer to it, that impacts financial markets too. I mean, we've had kind of a two-speed asset market, which is if you're one of the big mega cap tech stocks or gold or a handful of other assets, you've done amazing. A lot of mid-level companies just kind of chop it along. And in this particular cycle, we have not really had retail investors show up. So you don't see, for example, Google Trends searches for Bitcoin not doing particularly amazing. A lot of the demand this cycle has been on that more institutional side, which includes, higher net worth retail investors as well, and including, of course, some retail investors. But it's not a very retail-driven market like prior cycles generally have been. And that's in part because a lot of retail investors are strapped for cash at the moment. There's not, a lot of them are financially struggling because we have kind of an economic malaise. Kind of the one thing that does look pretty negative for asset prices, but it's kind of the era we're in, is low consumer sentiment. And business expectation sentiment. So a lot of the kind of the boots on the ground stuff is pointing toward weakness. And I would say the key reason for this is fiscal dominance, which is, for the most part, if you had consumer sentiment this bad, it would look like a recession. So a lot of these other things would also be rolling over. But because we have fiscal dominance, we get an unusual separation from things like purchasing managers indices or consumer sentiment, these kind of real-time gauges of the economy. While asset prices can kind of levitate. And that's in large part because of fiscal deficits. And I think that that's kind of a structural thing that we're in now. And so you get kind of pockets of weakness and pockets of strength, and just kind of ebbs and flows along that kind of run it hot floor.
Do you think that there's any risk of, well, there's always a risk, but what level of risk do you think there is that the U.S. is, facing some kind of major market downturn, the recession, I guess?
Well, there is substantial evidence of a downturn, so much slower job creation, and kind of potentially early signs of job losses. Nothing particularly confirmed, but kind of some alternative data have pointed in that direction. I think that as we kind of fast forward some period of time, I think we'll get through it. I think that these types of recessions, I've been using the term emerging market recession, which is to say recession feels different when you have fiscal dominance. So by some metrics, 2022 was a recession. If you look at the misery index, it hit recession levels. If you look at bank loan tightness, kind of their unwillingness to make loans, like senior loan officer surveys, that reached levels you only see in a recession. But it was offset by some of these other factors, kind of the fiscal deficits that had shrunk but were still large, as well as kind of backlog stimulus still working its way through the system. You had that kind of recession without a recession. Basically, what you didn't get was the labor market rolling over. You had a lot of other factors. And I think you're generally finding something now, which is you have consumer sentiment is already at recession levels. Purchasing manager indices are not at recession levels, but they're kind of at stall speed levels. And we still have signs of weakening. Now, as the Fed lowers rates and as fiscal deficits remain elevated, when we look forward, I think we'll grind through this and probably have another reacceleration cycle. But yeah, I think the next 3 to 6 months are kind of shields down.
When asked about the macro picture, Alden didn't hesitate. Liquidity is everything. She pointed to a turning point ahead, the end of the Fed's balance sheet contraction, followed by what she expects will be a gradual return to balance sheet expansion. Not a massive money printing spree like 2020, but a steady structural increase, the kind of quiet liquidity growth that supports risk assets for years. In her view, that shift, combined with ongoing fiscal deficits, creates what she calls a K-shaped economy. The top end, dominated by mega-cap tech and scarce assets like gold and Bitcoin, keeps thriving, while the middle and lower ends of the economy struggle. Retail demand is still weak, but institutional inflows are quietly building the foundation for the next wave. In other words, this bull market isn't dead. It's being rebuilt, from the top down. Alden even warns that the next few months could be choppy, job growth slowing, consumer sentiment near recessionary levels, and lingering policy uncertainty. But she sees these as short-term tremors, not trend reversals, especially with fiscal dominance now entrenched, meaning government spending keeps markets afloat even when the economy feels weak. The long-term setup remains decisively bullish for Bitcoin and other hard assets. And perhaps the most interesting wildcard, U.S. tariffs. Alden notes that the Supreme Court's upcoming tariff decision could swing hundreds of billions in either direction, effectively acting as another form of stimulus or drag on the economy. Add that to upcoming rate cuts, and it's clear. Macro volatility isn't going away, but liquidity isn't either. For long-term investors, that's the key. In Alden's words, this cycle isn't about quick 5x moves. It's about endurance, adaptation, and being positioned for the next leg higher. If you've made it this far, thank you for watching. I'd love to know what you think. Is Lyn Alden right that liquidity, not halvings, will drive Bitcoin's future? Or do you still believe in the old 4-year playbook? Drop your thoughts below. Hit like, subscribe, and turn on notifications. Because in our next videos, we'll break down how these liquidity shifts could play out across crypto and the overall digital assets sector as the Fed pivots into 2026.